Hello and welcome to this week's episode of Nucleus Investment Insights. Today we're going to talk about China. Whatever happens in China affects the rest of the world, so we're going to investigate if markets have understood and priced in the impact of a slowing Chinese economy. First on the agenda, we'll look at China's property crash. Prices continue to fall and construction continues to slow. Next, we'll look at China's lockdowns in response to OMICRON and whether they can sustain this type of policy without affecting their growth. Then we'll investigate China's fiscal and monetary policy, which leads us to the economic concept of the impossible trinity, which we'll cover in detail. And at the moment, China's control of interest rates and their currency is currently breaking down, and this is accelerating capital outflows from the country. Next, we'll discuss how China's been relying on elevated exports over the last few years of COVID, and this is now starting to slow with tightening in the US and around the world. Then we'll look at the Yuan and how these capital outflows are accelerating a fall in Yuan, and how this has knock-on effects for emerging markets, and how it also makes commodities more expensive in China, thus making it more difficult for them to stimulate. Then, as always, we'll cover the investment implications for markets at the end. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Today, as always, I want to welcome the Founder and Chief Investment Officer at Nucleus Wealth, Damien Klassen.
Hi, Sam.
Hey, Damo. Today, we also have our Chief Strategist, David Llewellyn-Smith. Dave, how you going?
Good, thanks, Sam.
Excellent. Good to hear. So just a quick reminder before we get started, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform. Our show's available on all the majors. And for those of you listening live, feel free to drop your questions and comments in the YouTube live stream chat, and we'll do our best to answer them during the show. One last thing, I just want to let you know that you can download today's slides from our website at nucleuswealth.com/webinars. We generally put them up this afternoon, so feel free to download them at your leisure if you want to take a closer look. So now we've got that bit of housekeeping out of the way, I'll pass it over to you, Damien, to get us started.
Yeah, so look, obviously markets, it's probably worth just making a quick comment. It has a pretty steep fall in US markets last night. And we've been talking about this and in particular the last few weeks. Sorry, I caught my throat. And so I guess we just wanted to highlight this is largely following the script so far. What we're going to see is you will see some pretty stark down days if we're right, followed by these couple of up days of increases, and things will look like they're reversing, and then you get that sudden drop again. So that sort of sits relatively typical in a bear market. You often get some of the biggest up days you get during bear markets, as well as the biggest down days. And so volatility very much is the name of the game, and I think it's hard to declare yourself a winner. You can. Until we sort of really see it at the whole sort of event fade out, play out. We are expecting continued volatility, and we're expecting to continue to see the thoughts around the recession. We ran this idea about the 6 major factors that's affecting a recession. That's looking like a global recession, and we are expecting that to sort of play out and get more incorporated into markets thinking over the next few months. And certainly, last night was one of those days where the market does seem to be waking up to the possibilities. The other one, though, which we don't think markets really have focused enough on, and certainly, when you look through commodity prices, it would certainly say that that's the case, is that the slowing in China, we don't think has been something that markets have priced in correctly. And particularly in Australia, just looking at the downside potential there. And so that's what we wanted to focus on today. So I might start, Dave, maybe we can just start with the property crash and your thoughts around that.
Sure. So regular listeners will be aware of that we've been talking about this property adjustment in China for, excuse me, a good year or so. And,
Well,
you know,
maybe,
it was
maybe 10 years.
well, in terms of its as a prospect for much longer, yes. But
Or-
the actual, but this particular iteration of downturn, excuse me. So this one, as is usually the case in these things, it has been triggered by policy, but it is unique insofar as it's a prudential move on property developers rather than directly upon property prices or the property market itself. And as we've described for months and months, it's called the three red lines policy, and it's basically just put a whole bunch of debt limits capping leverage in the Chinese property development sector. So that's had all of these pretty extraordinary knock-on effects with lots of distressed debt, lots of defaults, and also bankruptcies, developers going out of business, and therefore a huge kind of shake-up in terms of buyers of property in China and their faith in the development sector. And so sales have more or less collapsed on the back of that. So, we've started with developers and got a deleveraging process going deliberately after, the COVID stimulus, and it's now moved into a demand side issue as well, which is, authorities are saying that you can't speculate on property prices. It's, houses are for living in, and they've all, there's clearly a kind of loss of faith in the developers and their solvency as well, which you can just call counterparty risk. And so sales have collapsed. And so you can see how this gets into a feedback loop of doom if policy doesn't intervene. And that is more or less what's happening. So we've had sales in private measures have been averaging down about half for the last couple of months. No doubt, exacerbated a little by OMICRON and the lockdowns, but I think the vast majority of that half is still just the dynamics within the market itself. And with collapsing sales, of course, we've had inventory going through the roof, especially in the kind of wild west of China, where so much of the building has been since 2015 in the tier 3 and tier 4 cities, which comprises anywhere from kind of 70 to 80% of Chinese building. So that gives you some notion of how important this is for global commodity demand. And yesterday we had Chinese property prices and pretty shocking results, to be honest. I mean, we've had relatively stable prices through this adjustment, with the PBOC trying to keep credit reasonable enough to stop prices falling with this volume crash in building. But prices now in tiers 3 and 4 are absolutely going through the floor. So, you can imagine why, with all of this distressed property stock, huge inventories, lots of distressed developers trying to dump stock to repay debt, classic kind of debt deflation dynamics. And so there's kind of no immediate end in sight to this. I've put up a chart here that's kind of got some basic outlooks in it in terms of where a property starts by floor area volume, which is the key metric for commodity demand, versus sales. But this is, I think I used a three-month moving average for this one, and sales are far below where this chart is even suggesting. Like, this one's down kind of high 20%, I think. But sales have been down, averaging, as I say, well above 50. So most of the China watchers in the market, the merchant banks, etc., they all expect a recovery. Like they've been expecting a recovery for nearly a year. It just doesn't come. It just keeps getting worse. And, so nobody has this kind of scale of downturn in their numbers, not even the one I've drawn, and current sales are much worse. So I'm being conservative on this chart. And so, there is in property alone in China a very large risk of overshooting that's been made. It has certainly been made worse by Omicron, and I expect as things like Shanghai pass, we may see a bit of a lift. But the problem is, of course, with Omicron, it's almost impossible to extinguish entirely, and so you're playing whack-a-mole, and so you're always shutting down some material portion of your economy when it pops up in a new city. So Shanghai opens and Tianjin closes, etc., etc. And so at this stage, if there's going to be a recovery in sales, it will be minor, and I have very little faith in that, even myself. So,
can I highlight as well, too,
sure.
Dave, just some of the differences in China. Like, I mean, every property crash is different. Like they rarely, you rarely see exactly the same things that drove the prior crash causing the next property crash. And so, and particularly, like if you look at the US housing crash, like that was a prices driven, and because so much of it was in the hands of individuals, it was a prices driven one where people were over leveraged, and then they became underwater, and there was a lending standards that collapsed and all that type of stuff. And that's not the case in China in terms of its the individuals who are borrowing to buy land. Their debt levels are still, they've risen dramatically, but they're still not sort of at a scary levels, and there's not signs that they're massively out of whack. The difference in China is that the leverage is sort of like further up the chain, in that a property developer would sort of forward sell the entire property. Like so if you're buying something off the plan in Australia, you might usually put down a 5 or 10% deposit, and then when they deliver the apartment, now you pay up the rest. Whereas in China, people have been paying 100%, and then the developers have been taking that money and adding debt to it, and then throwing that into and starting to build. And so they've got this there's this additional layer of leverage and debt that's sort of built into the system, but it's all at the property developer end. And so that's why they were so incentivized to get out and really build. And that's why we're not talking about prices. We're talking prices are sort of, when David says they're falling, they've just turned slightly negative now. That's like
not in tiers 3 and 4 where most of the volumes are. The new property prices are now falling fast. Like tier 4 is down 11 over the year, tier 3 around 6, I think, something like that. But they're accelerating.
Yeah, but I guess what I'm saying is that's still to come, though. Like that price,
yes,
the danger from the
yes,
price,
it is.
The price falling. Like that's
well,
not what's causing it.
Price usually, not always, but usually follows volume, and so but you're absolutely right. It's not like the tier 1, kind of prosperous cities they're not really at risk here at all in terms of a price crash.
Yeah, it's the volume crash from the building of like, okay, we're gonna stop doing all this building that we were doing before. That's the other. There's two elements to it. Can you get a debt crisis, but also can you just get this whole, I've like used the numbers to say if you wanted to, even at current levels, which are down sort of 20% or whatever, if you wanted to get to the same number of starts per household as what you see in the US, you'd have to halve the volumes. Now, in some way, that's not quite a fair comparison, because China still does have a fair bit of immigration into cities, but that's sort of certainly slowing. But on the flip side is they've also got a shrinking population, and the US has a growing population. And so, you net, a more sustainable level of starts.
And China has immense inventory. The US has a shortage of inventory.
Exactly. So and that's exactly that. China's already overbuilt for a lot of the people moving into cities. So you could Like if I don't think if you had a if China housing starts halved and stayed there for the next 10 years, I don't think you're going to have any problems in terms of actual number of properties, and
No,
you're
you're
not
not.
going to have this. You're not going to have
No,
shortages.
no,
Like it's
you're
just
not.
yeah,
No,
it's
you're going to have a glut.
yeah, that's right. So it's really an
Yep.
economic argument about, is China willing to keep? That's part of the reason for these three red lines. Are they willing to keep just building and pumping all this money into that development sector, in order to keep employment up and people buying empty apartments and everyone feeling wealthy, or are they actually going to at some stage, that it's really a great big destruction of capital? Are they actually going to convert back into to more productive resources? And that's, to me, well, and I guess to us, that's sort of at the core of this, is saying, if they do actually have to at some stage reverse and flip around and sort of chase this property market higher again and throw more debt and everything at it, it's in the full knowledge that it's only a short-term thing, and they're wasting capital by doing it.
Yep, exactly. Okay, so we have this huge adjustment going on in China. I dare say at this stage we'd have to call it what you're really describing as a structural adjustment, Damo, rather
Yes.
than a cyclical one. Whether they're prepared to let it keep running or not, well, so far they have. Okay, so that's our first headwind in China, and it's a very, very big one. But it is being intensified by the fight against Omicron. And so we have to look at that as well and see what sort of prospects we get out of the zero COVID policy.
Before we get to the Omicron, Sam, there's a couple of questions
Yep.
that probably suit this this property side before we move on.
About iron ore here. So yeah, it's from what you're saying, Dave. Marcelo's asking, iron ore should be maybe around $60. He thinks, but he's just curious to understand why it's sort of maintaining above $120.
Yeah, well, if I could answer that, I'd be I'd be much smarter than I am. I mean, by my analysis, it should be down there somewhere. It's certainly the case that we had some supply, pretty heavy-duty supply curtailments through the first quarter, owing to the usual seasonal stuff, bad weather in Brazil in particular. I think, the Brazilian exports were down through that first quarter about 80 million tons annualized. But
and the Ukraine as well.
Yeah. Well, yes, we'll get to that. But those volumes are going to come back because none of the miners have cut their annual output targets. So that's passing, and in fact, they've got to make up those volumes. So that was one factor that drove the price back up from 85 to 150 odd through the first bit of the first quarter. Then we had Ukraine, of course, which is, kind of triggered just a massive, well, actually, we had a commodity mania going. We still do, based on, fears of stagflation and US inflation and, a crazed sort of financial bid for commodities. It's very hard to find evidence for it in iron ore, even in terms of daily and volumes, daily and futures volumes and stuff. But I don't know. My gut is that it's still there. And then on top of that, we had the Ukraine war start, which then just sent the commodity mania to the stratosphere. And we have Ukraine was exporting, I can't remember, 30, 40 million tons of iron ore or something. And it's probably down by half. So that's a little bit of a blow. Russia, of course, is sanctioned and everything, but then, its steel and iron ore volumes will probably just be substituted in China. Like, it'll ship its iron ore there as much as it can. China picks up that market share in its steel exports. There's a bit of the same in Ukraine with it losing some of its steel exports, but none of those are not big enough to offset anything like what we're seeing in terms of the downturn in Chinese demand. The other thing is there has been evidence of accumulating steel inventories in China. Like they're basically the highest ever for this time of year, considered by some margin. I think the steel mills are either like the rest of the market, anticipating a recovery, which I don't think is coming, not to the magnitude of those inventories suggest anyway, but they might also possibly be just under orders from Beijing to just produce, because unemployment is rising quite quickly, and so they don't want too many idle hands mulling freedom, and so that's a part of it as well. But I wrote a piece this week that broke all this down, and I called it at a loss, because, to be honest, I am at a bit of a loss as to why iron ore is so high. It shouldn't be at the price it is, and I do expect it to fall, but it'll probably be paced with the broader, and correlated to the broader commodity deflation as the whole global economy heads into a recession, which I think is, more or less unavoidable at this point. So it's a long-winded answer, I know, and it's not really an answer at all, but I expect iron ore will deflate. But there's so many cross currents in this, and such an intense bid into commodities in a financialized sense.
What David meant by that is that the number of banks and investment banks out there who are saying you've got to buy commodities to save yourself, to save them from inflation.
Yeah, buying them as assets, not to use them, just to hoard them.
Yeah.
And so
the problem with that is at some stage you start getting too much, and then you have to start selling these commodities, and so the inventories are growing. But at some stage, people start going, okay, well, I might believe that the Chinese government's going to step in and throw the kitchen sink at this. But I've already bought 10 million tons, and I've already got it stored, right across it, and running out, or spending all this money on storage space. I'm exposed to that. I don't need to keep buying more. And at some stage, I actually need to start selling. And if I start seeing other people selling their inventories, and I'm worried about the price crashing, then I'll pick up my entire 10 million and dump it onto the market, because I need to. I'm only owning it as a trade. I don't want to get caught owning this when things start to crash. So that's the danger of the financialization.
And there is, of course, infrastructure stimulus in China, which is something an offset to property, and the export boom probably plays a small role with more steel. But yeah, basically iron ore should be lower, and I expect it to go lower. So is there another question there, Sam?
Well, the question was, will they throw the kitchen sink at it anytime soon? The other one, which is
well, let's come back to that one, because that kind of plays into the whole narrative of this this presentation. So we'll answer that question as we go along. So anyway, back to our second headwind for why China is in Omicron and lockdowns, of course. Can it beat Omicron? Well, it is beating Omicron at the moment. Case numbers are falling away quite sharply, although they keep getting the outbreaks in new areas. I don't think that they can extinguish it, no. And I, as a denizen of the world's most locked down city in Melbourne, we have some personal experience of how difficult Omicron is to stamp out. Obviously, in a democracy, we don't have certain autocratic tools that the CCP does. And we've probably all seen some of the videos of the Chinese being rounded up and shipped off to various quarantine facilities and things. And so they'll be more successful than democracies have been. But it's simply too contagious to stamp out. And so I expect it to ultimately fail. And in the end, it needs some mRNA vaccines.
Yeah, and isn't the point though? Is success or failure isn't as much of an issue as it's going to keep needing to do the lockdowns.
That's right. Exactly.
It could stamp it out, but they'll sort of come back. It'll come back at some stage, and they'll have to keep doing the lockdowns.
Yeah. And it's whack-a-mole. So
yeah,
it's perpetual economic headwind.
Yeah, and Xi has sort of built this whole narrative over the last few years of what a great job China's done versus the decadent West, and how much better it is, the Chinese system, and saved all these lives. And he might be right. Who knows? But the point is, he's built this narrative around it, and it's very hard for them just to sort of suddenly say, oh, that stuff we've been telling you for the last 2 years, actually we were wrong. They got it right in the West. Let's just let it rip and see who dies. If they want to do that, they're going to take it's going to take months worth of gradually steering that sort of ship around before they finally do it. It's not going to. I think it's very unlikely we wake up tomorrow and they've decided, you know what, let it rip. And so
they won't. And they simply haven't had high caliber enough vaccines. But there are a bunch of mRNA vaccine developers that are fairly advanced now. One's in stage 3 development, so they'll get those eventually and roll them out, and then they will let it rip, I guess.
Yeah.
So
at that stage, then the narrative will be, hey, we've got these great new Chinese RNA, far better than what they made overseas, and so now we can afford to.
Exactly right. Yeah, far better than the decadent vaccines of the West. So, but for the time being, we're kind of stuck with it. So expect rolling lockdowns, basically. And by lockdowns, there are obviously degrees of lockdown. And if you look at it, I haven't put the chart up here, but, Shanghai had a very severe lockdown, which it will be progressively coming out of now. But, something like a third of Chinese cities have incremental lockdowns that haven't changed at all. So they're all in, an enormous slab of China is in partial lockdown that it'll basically have to stay in. And so, mobility and stuff is a huge problem. And so it will be, a lot of sand in the gears of the economy. So,
really quick aside though on the whole supply chain as well. I did notice some of the ship numbers in Shanghai have already started to start to clear, and I guess just we saw this problem in the US where the ship numbers just built up and just kept on building up and building up and building up, and they just couldn't get rid of them. Part of the problem was in the US is that they're not as automated as what you see, and there's relatively heavily unionized and constraints on when they can and can't do stuff. I think I'm expecting that the Shanghai end of the pipe will actually clear relatively quickly once they sort of reopen it. Even at the stage they are now, because they will run. They're a lot more automated. They will run things 24 hours a day. I think there's I think that the extra capacity sort of sitting in the Chinese economy naturally because of all this infrastructure spend, overspend you'd call it, will be useful for clearing that and pushing the blockage back over to the US if that's the case.
So the policy responses, and I guess we're coming towards answering the good viewers question at this point. In terms of, what are they going to do about this? Because they are in deep recession. Unemployment is the last number I think I saw was like nearly approaching 7%. And we all know that the CCP is highly allergic to unemployment. So what are they going to do? Well, they're doing lots of stuff on property. There's been loads and loads of prudential easing, and by that I mean, local restrictions on like the number of properties you can buy. If you're an investor, buying second, third properties, that sort of thing, and they're all easing up. Lots and lots of that going on, but that's been going now for months, and it's done nothing. The problem with it is that why would you buy even more of a devaluing asset that you don't even have any faith will be built, because your counterparty may be out of business tomorrow? So the real problem here is counterparty risk, and they are sort of trying to address that as well by propping up, they're trying to innovate various ways that the developers can issue new bonds, new debt, so that they can stabilize their balance sheets and things. But none of it's working because the three red lines are still there. That's capping their leverage, and so they're all just frozen in terms of, like the developer bond market is frozen. The spreads keep just grinding higher. They're locked up, and doesn't matter what anyone's doing, it's not working.
Sorry, I think it's Sunak defaulted just recently, and they were
right.
3 or 4 months ago thought to be one of the better ones.
Yes, exactly right. And that's the problem with the doom loop and the debt deflation. Those that went into it with really apparently or ostensibly good balance sheets, if you cut their sales by 50%, well, then what balance sheet's going to survive that?
So, well, and the other thing is that there's the edict came out, that a lot of the off balance sheet. I think that Sunak was one of the victims of basically, as they start digging, they start going, just a minute, you've got all this stuff sitting off your balance sheet. We need you to bring it back onto the balance sheet so we can actually see what's going on. And at that point, it was like, oh, well, actually, yeah, we do have all this debt at a lower level as well. And then, and that suddenly, sent shockwaves through. And that was pretty much what happened with in the financial crisis with in Australia with a lot of the Allcos and Babcock and Brown and those ones, was that, at one level you'd sort of sit up there and look at the company and go, oh, actually, it's got 60% debt. That's a okay, it's not good, but that's manageable. Prices would have to fall 40% before they start to lose out on that. But then what it didn't say was that actually underlying that there was another entity. The assets were sitting in this other entity, and that thing was geared to 50%. And that would then there was another one below that was geared to 50% as well. And so then you add them all up, and all of a sudden you're in your 90% gearing at sort of if you take into account the underlying bits. And that's what's been there's sort of been as the tide goes out and they start to see some problems, and they start saying, oh, actually we better make sure this problem we found at Evergrande doesn't exist elsewhere. And then all of a sudden you start finding these other things where people have been hiding where the leverage was.
Yes, and of course, as bad as Babcock and Brown was, I think it would pale into insignificance versus the chicanery that has gone on in the Chinese development sector. And it's been the wild west of leverage for the last decade. So,
and this is a classic cycle where if you're making 10 to 20% returns every year on something, then the more gearing you can possibly have, the better. And the companies that actually gear themselves, if you've got, so you go back 10 years or 20 years and you've got these property companies in China looking at, the next another decade or 2 decades of 10, 20% property price growth. The ones that went, oh, I'm going to be quite conservative and let's just run normal, development ratios, they're the ones that got left behind. Like the ones that grew the biggest were the ones that went, no, we're going to push the envelope right to the limit, and we're going to gear ourselves and hide the gearing everywhere, and we're going to be geared at 90% or 100% on this stuff, and we're just going to reap these profits as prices just rise by 10% every year. But then as soon as that stops, the companies that are the biggest are the ones that were also the running the most dangerous strategies in terms of leverage.
So they got this problem with the distribution of credit, which is being, plugged up by the 3 red lines and the counterparty risk, and that's stopping, a reasonable amount of liquidity that the PBOC is pumping out from really reaching anyone. And the PBOC has cut various interest rates, not the sort of loan prime rates, but reserve ratio requirements. They did drop mortgage rates a few weeks ago by 20 basis points. Lots of different tinkering. The question is, with China in absolutely deep recession, and is why they're not cutting their loan prime rate. Effectively their cash rate, and we'll come to the answer to that. That's basically, I think they're terrified of capital outflow. But for the time being, the stimulus on the monetary side is still pretty targeted. It's not broad-based, and it's certainly not the kitchen sink. And we'll come very shortly to the reasons for why. But for the time being, the efforts that they are making are not working, and the transmission is plugged. They're pushing on a string in monetary terms. Now, the same can be said of fiscal policy.
Before you get off the monetary policy, Dave, I mean, the
Yep.
other argument on the monetary side is the one that Michael Pettis makes consistently, is that China is different in that they have repressed the borrowing rates for companies. So basically, what let's say in Australia, let's say you're sitting at an equivalent economy to China, and you might be your depositors might be putting their money in the bank and getting like a 3 or 4% return, and they're lending it out to companies at a 5 or 6% to companies, and so that's the way things go. Is everyone gets an economic return. In China, what they've done is they've repressed the interest rates so that they're effectively paying depositors, rather than the 3 or 4% they should have been paying, they're paying them 2 or 3, and they've brought the lending down for the companies. And so what that's meant is, by repressing all these consumers, you're giving companies basically a bit of a free kick by giving them all these cheap loans, and that's what's helped sort of drive China over the last 20 years, because companies can borrow really cheaply, and so invest in more production and then employ more people, and so that all made sense until you started to fill up on, you ran out of these productivity gains. And so the argument he's making is that, well, companies already have cheap loans, cheaper than what they should have, and cheap relative to inflation and all these other factors that's going on. And so if you turn around and lower interest rates by more, the companies aren't going to go and do more, because they're already doing as much as they could do anyway, because the loans are cheap enough. It's not like the price of money was a constraint on them. But the problem with lowering rates is you're actually taking a lot of your consumer sector who's providing all these deposits and taking money away from them. So you're actually reducing the income of the very people who you want to try and increase the income for. You want to try and increase income for the consumers, so they can actually get out and spend money and get the push the Chinese economy along. But by cutting rates, whereas in Western countries you cut rates and a whole bunch of people then go out and borrow more money and buy more houses and bid up the price of houses. It's like, okay, well, that's in theory that's a positive. Well, it's certainly an economic positive for. But the story is not the same in China, I guess, is the point it's making. And so, and to conflate,
well, it is, but they consider it to be bezel and are trying to stamp it out.
Yeah.
The question is, can they do that without bankrupting their financial system?
Exactly.
So anyway, fiscal policy is also inhibited for a number of different reasons. Like, I'm very much along the lines of what Damo just described. A lot of what they're doing is tax cuts for companies and stuff that simply don't need it. So that's going nowhere. There's a big push into infrastructure, but of course, you can't build a bridge if your workers are all sick or locked up at home. So Omicron is delaying the rollout of a lot of the infrastructure. But just as importantly is the property bust has a dire pro-cyclical feature to it for fiscal, which is they can't sell land. The local governments that deploy the infrastructure spending in stimulus are unable to sell any land, and so they're certainly selling bonds and raising debt to build some stuff, but at the same time they're losing all this land revenue, and so it's kind of robbing Peter to pay Paul. Now, as Omicron lives, I do expect there'll be a more of an infrastructure bounce. Most certainly, that's what they're aiming to do, and it will happen. But it's going to be coming along right alongside the crash in property starts, so which are still on the way down and accelerating on the way down. So the net result, may well be negative. If it could be marginally positive, it's very difficult to say. It's too many variables, but it won't be great. Won't be any kind of winning recovery.
And just to put that in perspective as well, as an example, that if you're say you're a local Chinese administrator in one of these provinces, and last year you sold $1 billion worth of property, and then you went and took that $1 billion and built some roads and bridges and new airports or whatever it is with that money, is that what's happening is the the central government is coming back to you saying you need to get out and spend more this year. You spent $1 billion last year. We want you to spend 1.1 or $1.2 billion. And at the same time, you didn't get $1 billion this year from land sales. You only got 700 million. And so now you've got to borrow the difference of whatever you want to spend. And it's a very different atmosphere in terms of, if you have a debt crisis as a local government official in China, you can end up in jail. Like it's not a, you did a bad job, you're fired and go find a new job. It's you did a bad job, we're throwing you in jail and punishing you in other ways. So as a local government official, yes, you do want to go out and spend that $1.1 billion that the local government, the central government's telling you to do, but you also don't want to go to jail. And so maybe there's a bit of, there ends up being a bit of sleight of hand in terms of, the number of announcements you make might not quite match the amount of money that actually gets spent, or there's various ways to inflate things that don't actually end up in that real economy. And so, the announcements might end up being greater than the actual effect. And that's that pro-cyclicality David's talking about. When everything's going well, they're incentivized to go out and spend even more. But once things go badly, everything can go badly all at once, and it makes everything worse.
Yes, quite right. So we come back to the listener's question here, which is, will they throw the kitchen sink at this because they simply can't get their growth going? And this is where we come to, China's impossible trinity, which is, in the theory of macroeconomic management and monetary policy, a central bank can only control 2 of 3 variables at any one time. You can try and control or influence the value of your currency. You can motivate or dismotivate capital flows, and you can control your interest rates, but you can only do 2 of the 3 at any one time. You can't do all 3. Now, so far, China has not cut rates, the prime loan rate, and so it excuse me, it's in effect it's decided to let this adjustment continue, right? But its currency is falling anyway because its growth has been smashed, and so the yuan is plunging, even though the PBOC has kept rates at a reasonable, stable, which is pretty unusual. So its impossible trinity is starting to break down here and cause it, quite a lot of economic dyspepsia. Now, I think the PBOC basically, is motivated by Beijing's goals of ending this kind of great property plunge that they've had over the last 10 or 15 years, but it's also, I think, terrified of capital outflow, because if the capital outflow that began this year, and there's a chart here showing how it's been running, was to really intensify, then you'll get a credit crunch in China because interest rates will start to rise for various segments that are issuing debt, if they're doing it in US dollars especially. So I think this is one of the reasons why the central bank in China has been so slow to cut rates, because it's terrified that the falling yuan will get out of hand and capital outflow will really accelerate. And of course, it's got Forex reserves that it can spend on controlling the currency, kind of trillions of them sitting in various US treasuries and things. But we went through this in 2015, and it exhausted those surprisingly quickly in 2015. So it doesn't want to go there again. But it's in this trap, because if it doesn't cut rates, growth falls and capital flows out anyway. And some interest rates are out of control upwards in China, and the prime example is the developers. They simply cannot sell US dollar debt, which is what's driven so much of their boom for so long. This is why I think they're not throwing the kitchen sink. It's also why, I'm not sure they can throw the kitchen sink, at least until the Fed has stopped tightening. Like, as long as the Fed is still tightening and the US dollar is rising, if the PBOC was to cut now, then capital outflow will most definitely accelerate dramatically, and China risks an external crisis. A classic kind of emerging market capital flight, crisis, in which this is a risk case. This is not a base case, but if it were to happen, it's simply where in places that we've seen in Russia, Turkey, others, where the central bank is forced to raise interest rates into a recession because they've got to stabilize the currency and the capital flows. Now, it's not, as I say, the base case for China, but it's not impossible there at all, and it looks more precarious there right now than any time since 2015. And to be honest, if the Fed can't stomp on inflation quickly, then that threat is going to rise, and it's going to really unsettle people. Now, there is one other feature. Oh, sorry, we'll move on with that. Actually, come back to that with the Yuan. So China's in a precarious position here. Its domestic demand has been smashed by lockdowns and the property adjustment. It's pushing on a string in fiscal and monetary. It's going to get a bit better, but you're not going to get any tearing rebound.
Well, and having said that, if they focused on the consumer and sort of were doing more like direct cash handouts that you saw elsewhere, like that's
sure.
positive,
they're just not. No, there are things they could do a hell of a lot better that would fix things. Well, help fix things, but they're not. So their problem is that things are about to get worse as they try to restart domestic demand out of Omicron, and that is because the Fed is tightening fast. There's another 50 coming in June and 50 coming in July. Where the Fed's about to stress test the US consumer, as well as leverage in the corporate sector, markets themselves. This is what all of this volatility in equity markets is about, and all of these things. Basically, the Fed has to squash US inflation. It's got reasonably heated wage claims going on. It wants to stop that, and it's odds on that they'll certainly need to drive growth down to near zero to achieve it. Now, in effect, what this is going to do is deliver an external trade shock to China. We've already got goods volumes tapering off in the US because of the handoff to services post-COVID. That's being kind of somewhat disguised in nominal terms because of inflation is driving, strong sales growth, but the volumes underpinning that are actually tapering off the growth. But if the Fed actually succeeds, when it's more a question of when the Fed succeeds in delivering a sufficient shock and hiccup to consumption in the US, that's going to immediately spill over to China. Now, to make this even worse, the US has enormous inventories of everything now, largely because of, all the supply side bullwhip effect coming out of COVID, which was, everybody freaking out about supply chains. And so they've all built this huge pile of inventories. And so if they get a demand hiccup, then they'll destock all of that. And so you'll get a pretty hefty trade shock, not just to China, to Europe, to everywhere coming out of the US. And this is almost unavoidable in terms of what the Fed is going to do. Now, I don't know what the trigger is. I don't know what breaks. Something will break, though. That's how these things go. When the Fed is on a tear trying to stomp on inflation this much, then eventually something just goes belly up. And it may simply be equities. That might be enough. If the equities bear market in the US were to fall another, 10, 20%, that might be enough to shock the US consumer. And we don't need to have a credit event. But, credit spreads are blowing out. Not enough yet in investment grade, but most certainly in junk. And so there are going to be victims from that. And we don't know where they are, but they're coming. And so there's a trade shock coming to China, just as it tries to repair its domestic demand. And so, this is a real problem for Chinese growth. And so, if we flip over, then so what
Actually,
can they?
before we get off this one, I just want to highlight as well on this chart. So and for anyone who's not who's just listening in and can't see the chart, basically what it's showing is Chinese economic growth and how it's been driven over the last couple of years since COVID sort of started. And we can see construction sort of at the bottom of the range. Property sales is not far off, both quite negative at the moment. Retail sales has taken a real hit, but right at the top of it is exports. So what's really sort of brought China through this whole crisis is the fact that exports have grown so quickly, and most of that industrial sales and things like that. And so the danger is that every other part of your economy is weakening, and you can see in this the FAI line is the fixed asset, which is the government. Yeah, government's out there spending money on infrastructure and everything. Like that's already started to turn down. From its levels. If you see that exports take a big step down, like that's the one remaining strength, I guess, in the Chinese economy, and that's where you really see the rubber start to hit the road. Is that then they're going to have to spend even more on fixed assets just to try and offset the effect of the exports. And so, and that was really what helped. The whole exports was what really helped them manage this property downturn for the last year or two, because yes, property is very, very weak, but exports were really strong. And so net, people are still employed and money's still coming in. And so, it was a good chance to offset. So that's the danger is that you get them both falling at the same time.
Yes, quite right. So, and I think that's what's coming. They're going to get some kind of domestic demand recovery, but it's going to be this external shock is going to land right on top of it. Again,
we've got a couple of viewer questions coming in here. So just two questions actually. One in the context of China's economic growth. Joe's just curious to know, what's happening to China's productivity. Is it decreasing sort of relative to other countries? So the first question's around productivity, and then second question. Cam saying military action and expansion is a great way for authoritarian regimes to keep power when the economy tanks. And just like to get your thoughts on that as well.
Okay, so second one first. I don't think they're in a position to do any military action on Taiwan yet, so I'd be very surprised if that happened. Sorry, what was the first one?
Actually, just productivity. But actually,
productivity.
Just on Taiwan, this is this issue that we've seen from Russia is that the whole world's turned on Russia, and Russia, as a commodity exporter, it's actually not that bad when people put sanctions on you. Like we actually saw that Australia was actually the test case for that. China came out and put all these sanctions on, unofficial sanctions, but basically stopped buying all Australian commodities. But because we had other people who were willing to trade with us, we just switched with a lot of that. There's some problems where you can't say education, but all these commodity stuff is we just switched. So Russia then where they're really struggling obviously is things they can no longer import and some of the sort of more value added ones. But the commodities, a lot of it's just about moving it around and saying, okay, well if Europe's not going to buy it, then I'll sell it to Asia or sell it to India or whatever. And so that's where Russia is. China's in a much more precarious state in that they don't have they import commodities, they export all these value added goods, and once if you start getting similar types of sanctions on China, because there's so much more plugged into the world economy, and there's far less reliance on commodities, commodity exports, is they would suffer far more than what we've seen in terms of Russia. So the sanctions wouldn't need to be anywhere near as large to have a much bigger effect on China. And so I think probably the one thing for me that China would have taken out of this was, whatever they want to do with Taiwan, they really need to be prepared to take a significant economic hit if they want to do something about it.
which I'll come back to in a minute. On productivity, it depends who you look at. Like there are some very credible people like Conference Board that are showing Chinese productivity has been flatlined for years. I'm talking multi-factor productivity here, which is both labour and capital, which is the one that matters. And yet I've seen some others that are still reasonably strong. I find it hard to believe that, well, I guess in the broadest sense, there's so much capital misallocation in China, particularly into building, that it's entirely plausible that their productivity is really up the spout. And that is what they're trying to fix with this adjustment. And if they persist through it, you would expect capital productivity to rise a lot. At the same time, you've got, like this intense, enormous, rather unskilled workforce that has got huge latent productivity in it, like in terms of upskilling them, educating them, robotic or sacking them for robots, et cetera, et cetera. So, China is.
The question
China
there, though, is. Sorry.
I mean, at this stage, I can't really answer the question decisively. They are trying to lift their productivity. There is a lot of potential productivity, I think, in their labour market, and they are limiting the capital misallocation. At the same time, though, they're stuck with their SOE model. There's not a lot of competition. There's graft everywhere. Obviously, the stuff that's going on, say, for instance, in the tech crackdown, where the CCP is taking board seats on all these tech firms, that is not very productivity enhancing. When the government starts to occupy, your most intensive productivity enhancing sectors. So it's a real mixed bag.
Well, and I'd say as well, like I don't disagree. There's a latent productivity in the workforce there. I guess I just find it hard to believe that, like I think for mine, the workforce has gone over the last 10, 15 years has gone from very unskilled to moderately skilled, and now the next step from moderately skilled to quite skilled is actually quite a big jump in terms of and it requires a freedom of thinking, and it requires
no, it's a good point.
The first step is about saying, okay, we need to educate people, or teach them math, teach them these things, teach them how to copy processes and have processes like that. Whereas the next step is, okay, now you need to go out and have freedom.
You've got to innovate. Yeah.
That's
So what we're really talking about is the middle income trap here, aren't we?
Yeah.
So
and that's where I just think
where they try.
People, you're not allowed to think this.
No, that's right.
You can only think exactly what we tell you to think. Now go and be innovative.
Yeah, that's right. Yeah, the beatings will continue until innovation lifts. So no, I mean, I think that the base case is that China's productivity stagnates into the middle income track. Yeah, that's right. So back to what we're talking about here, about where this all comes to bear upon global markets and us, and it's all about the yuan. So for all these things that we're seeing, we've got stalled growth, all sorts of defaults, and this is where the Russia sanctions issue comes in as well, in terms of there's now a big geopolitical risk hanging over China, because everyone knows they want to take Taiwan back, and everyone now knows what will happen when they do. There'll be a sanctions regime vis-a-vis Russia. And so these are really big motivators for capital outflow. And so the yuan is falling. Now, the PBOC is actually fighting it, but, the real effective exchange rate in China is still very high, actually. And so it's got room to fall, and will, in my view, keep falling. And so this comes back to, firstly, the possibility of an external crisis, which I think is still a risk case, but I think the base case is that the yuan's going to keep falling. So that flips us over to the where the rubber really hits the road for global markets. And the simple fact of the matter is the world almost can't abide a falling yuan. It blows up markets. Especially when the US dollar is rising at the same time, and they tend to happen together. It lifts geopolitical risk, a la Trumpian trade wars. It squashes broader emerging market competitiveness. It hurts commodities and makes local commodities in China more competitive and more expensive overseas.
So sorry, let me just explain what David's talking there is. So basically what you're saying is, let's say the Chinese yuan falls by 20%. Now China's if China's making a shirt, it's now 20% cheaper to buy that from China than it is to buy it from India or Vietnam or Bangladesh or wherever. So all of a sudden, all these other emerging markets are suffering. And the flip side is if you're selling iron ore to China, iron ore's just got 20% more expensive if we're importing it. If China's importing it, but if they're making it locally, it's just become 20% cheaper relative to say Australian iron ore. So at the margin, everything.
So they dig up more at home. And so it becomes very deflationary, basically, for the world, a falling yuan. Now, the other quick thing that I'll note is the Australian dollar nearly always follows the yuan, and so does the euro, actually, or it might be the other way around. I'm not sure. But they tend to trade together. I don't see any respite for any of this until the Fed's finished. And given the Fed's not really going to be finished until it's forced, consumption lower in the US, then that's going to come with the trade shock we've already discussed. And so there's no respite for China in that either initially. So this scenario is like 2015 and 2018 on steroids. The only difference is there's no Fed put to save us because the US has got such an entrenched inflation problem. There is, in fact, a Fed call over markets now where anytime they rally, it loosens financial conditions, inflation stays higher. And so it goes counter to everything that the Fed's trying to achieve. And so markets just realize this very quickly and start to fall again.
Well, and in China, in 2015, 16, China, when they're having similar problems, they set up an accord. I'm trying to remember the name of the accord with.
Oh, that's right. Well, it wasn't official, but they had the Shanghai Accord. Yes.
Accord, yeah.
Yeah, where the Fed and the PBOC more or less agreed that the Fed would stop tightening, and the PBOC would loosen, and so you got more growth in China and more liquidity out of the US, and that prevented the yuan from falling any further. But of course, they're not very friendly anymore.
No, that's right. Yeah, and since then we've had a Trump presidency, and
yes,
and things haven't reset under Biden.
Yes,
they're just
so a crashing yuan basically is a key component in a global hard landing, and that risk is intensifying really quickly. The two sort of scenarios that are on deck right now are Fed tightens enough, inflation starts to fall a little in the US, Fed eases up, maybe you get a soft landing. That's the glass half full view, but that would still be a stagflationary environment, and I don't think that's all. I think that's a risk case, to be honest. I think the base case is that the Fed overcooks it, something breaks, and that something may well be China, I might add. And so, and it most certainly is the yuan. I think it's going to continue to tumble, even though they fight it. I just think that they're stuck in this no-win situation. And so, what we have in the market setup right now is incredibly inflated and overvalued commodities, and a a bond market capitulation that is expecting inflation and growth to go, to be a sort of trend change, a shift in paradigm, if you like. I think both of those things are going to unwind.
Okay, great. Nice one, Dave. Thanks for that. So this is the last call for any viewer questions before we go to the question of the week. So just drop them in the chat box below and we'll answer them after this segment. So now we've got our viewer question of the week. So this is for viewers. Have some discussion in the comment section over the coming days. The question for this week is, will China have an external crisis? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. So we've had a couple of questions come through. So one of the viewers is saying things are looking a little bit grim for 2022, 23 in China, the US, and Europe. So the question is, who's going to lead us out of this in time?
Well, the Fed will lead it out once enough of the COVID stimulus has flushed through the system, and they're happy that they've squashed inflation. The Fed will flip, and then once that pivots in, markets will reflate like nobody's business. So this is the beauty of markets and the wonder of investment. You got to hopefully time these cycles right. In effect, what we're looking at here is a kind of accelerated business cycle, which we've noted time and time again over the last 2 years, that the COVID cycle just dramatically accelerated all business cycle dynamics. And now we're going to see the denouement of it.
Okay, great. And Damien, have you?
I should add as well that the moment the Fed flips, China can stimulate more as well, because the pressure comes off the Yuan.
Yeah, and so it's and our expectation is actually this is going to be quite sudden. So it's that that what we're looking at is it's inflation that's keeping the Fed from pushing it, and a lot of the inflation battle was last year rather than this year, and so they'll push things too far, and that the inflation is going to come off quite suddenly, and that they'll then need to flip 180 back into supporting the economy. And so there's going to be a time in the next, I don't know, 6 to 18 months where going to want to flip. Well, maybe I don't think 3 months would be too short. Yeah, that's right. It could be shorter. But look, we're underweight equities and overweight bonds at the moment. There's going to be a time to flip, and you're probably not going to have a lot of time to do it, I guess. Is so I guess our approach is saying the market falls another 10%. Say we're going to be starting to edge back in. We won't be thinking I don't think that'll be the bottom yet, but there's a certain point where it's like, well, you can never pick the exact bottom, and it's about trying to work out how cheap you need the market to be, and before you actually start buying in and building up. But there's we're a lot closer than what we were 2 or 3 months ago to that point, and I think it's going to be quite sudden.
Yeah, I might note as well that China's in real trouble. There's the possibility of balance sheet problems in China. This could be a bit of a long cycle event for China. But everywhere
China's
else,
Japan moment where they went.
Yeah, but everywhere else is okay. So it's not what we're not talking about a GFC here. It's just a classic business cycle.
Okay, great.
There's another question.
I think that's it for the questions.
Food and energy crisis. I thought it's worth. So basically, So who we got? Wiser 3754 is asking: is China facing a food and energy crisis?
Well, everyone's facing an energy crisis. I don't think China particularly is facing a food crisis. I mean, emerging markets are facing a food crisis. And that looks pretty baked in. with the gas price driving the fertilizer boom, and that's just filtering through.
Price boom. Yeah.
Sorry, fertilizer price boom.
But volumes
Yes.
in fertilizer is going to be falling. So
yes. And so yes, that is definitely, there's a whole bunch of possible black swans around that Arab Spring. A lot of those countries have oil. It's very high, so they could probably pay the populace off, but some don't, and they can't. So that's definitely another concern to add to the mix. But I mean, the energy crisis that we've got right now, we think will resolve over a few years, as Damo's sort of described. The commodity supply side, it's very fungible, so it'll get worked out. It might take 2, 3, 4, 5 years, but it'll get worked out even without Russian supply. But we may need to. The Fed's got to snuff out. I think the Fed's got to snuff out oil before it can stop, and then we might get another oil pop in the next cycle before enough renewables are rolled out, or EVs, or whatever it takes. But it'll work itself out eventually, and in the medium term, I think, rather than the long.
Yeah. So I guess our overall thoughts on energy is, your medium term view is, look, it's not a problem. The short term view is, it's going to be problems. There's going to be too much, and then there's going to be too little, and then there's going to be too much, and then there's going to be too little. It's going to be volatile over the next few years, and it's hard to know how much too much and how much too little, and where prices can go. But I think in 10 years' time, you're going to be looking back at this and going, wow, oil went to negative something, and then it went up to 150, and then back down to 70, and then back up to 140, and it's just doubled and halved several times over like a couple of year period, and then everything's been electrified, and that's just gone away as an issue. But but we're in the middle of that right now, and it's going to be I guess I certainly wouldn't be I wouldn't be holding long-term positions either short or long in that sector. I'd be sort of trying to be relatively circumspect about saying, well, at over $100 bucks, you'd want to be lightening it up, and if you're closer to 50, maybe you're starting to buy some. But it's not sort of a set and forget sector for the next little while.
Yep.
Excellent. So that almost wraps us up. So Damien, just want to thank you for sharing your insights and knowledge as always.
Thanks, Sam.
And Dave, thanks again for joining us and sharing your global macro insights.
Pleasure. Thanks for having me.
Excellent. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments below, or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your financial situation, please go to our website at nucleuswealth.com, and you can book a call with me or one of the team. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. And also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can follow us on all major social media. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.